everyone, Dr. Donna Barris here. Welcome to Accounting 101. This is week 9 of our overall 16-week semester. We are more than halfway done. We've done the midterm, it's behind us. So everything going forward will be focused on the finals and getting a good grade to pass this semester. So today's topic, when you hear the term ratios, what come to mind? So ratios mean comparison, comparing one to another in relation to, and we are going to discuss financial/accounting ratios today. So no different than the general definition of ratio, which is comparing one thing to another or finding a relation between two or more items. With accounting ratios, we use the financial statements, and based on what is going on, we can use that financial statement to do a comparison of previous years, or we can compare how that company is performing in comparison to another company within that industry. So there are some key ratios that we want to go through today. So you will get your pens and papers, and I'll tell you the definitions of them, what they mean, and how we use them. All right. So before we get into that, there are why people use ratios, right? So remember a few lectures back, I told you that stakeholders or people on the outside when it comes on to financial statements. So those four main ones, people on the outside that are potential shareholders or potential owners of the company that want to buy into the company, they are not privy to inside information. So the only thing that they can use is financial statements that are released by the company to make informed decision on whether we should invest in that company. So those statements give you some key performance indicators, and you can take those key performance indicators and use some mathematical analysis and ratios to see the overall health of the company. And I'll give you a perfect example. There are some companies out there that are cash flush, and that means they have a lot of cash. And on the face, that could be a great thing, but you have some ratios that really look at it and say, certain industry, you shouldn't be cash flush. You have certain industry that have a lot of long-term assets, right? Assets are things that we own, but long-term assets would be, what happened if you get into a jam? How quickly would you be able to sell off some of your assets to pay what you owe, which would be your liability? Is that a company that you want to invest in? So even though on the face of the financial statements, everything is good and everything looks pretty, you as a potential shareholder have to do deep dive and deep analysis in regards to, is this company healthy enough for me to invest in? Or is this something, what are the risks that I'm going to do? Is it a low risk company? Is it a high risk company? And it depends on your tolerance. All of those, one of the things that you can look at are certain ratios in regards to how they're performing, how they should perform, how they used to perform, how they perform in comparison to a competitor, and that will be able to help you make detailed decision in regards to whether you should invest or not, okay? So we have a few main ratios, and I'll be perfectly honest with when it comes on to ratio. It is not a hard topic to understand, but honest scout honor, one of the things that I try to do is make sure I am very real with you. It might not feel that it is applicable to your life. I'll be honest, not all of the ratios will, but some of them do. And so this is why it's actually important. You'll be like, Dr. Boris, are you pulling my leg? No, I'm not. And I'll give you one of the perfect examples that I am jumping ahead. But if you're going to apply for a mortgage to buy a house, or okay, you're saying I am not even ready to buy a house, but let's say you're going to apply for a Macy's card. Am I down your street now? What do? They pull up your credit history. You say, wait a minute, what does my credit history have to do with this? Those companies take your debt to equity and they do a ratio and they compare it and they say how likely are you to pay your bills, and that determines if A, you get qualified, or B, if you do get qualified, what rate you get. Are you a delinquent risk? What is your risk in regards to defaulting? You're like, oh, I'm coming down your street. All of those come into ratios. So no, Macy's is not just going, I don't like your name, so you get denied. The sales lady that puts in your application has absolutely nothing to do with whether you're qualified or not. It is on the back end that they're using information based on your past credit performance, and they're doing ratios to compare, and then based on that ratio they match it against the quota that you have to hit. If you hit that quota, it depends on what is the standard deviation to tell you how much you get qualified for. So you and I can walk in and we can apply for the same Macy's card, and you can get approved, I can get approved, but we get different amounts. It's not because your smile is prettier than mine, or it's not because you asked really nice. It's all about the numbers. So that's where ratio comes in. Another example, if and when you decide to buy your house, when they're doing the mortgage analysis or you're applying for any loans, the bank come in and the bank might even, there's something called debt to equity ratio. The bank looks at it, how much you owe versus your worth, and they're looking at it for a specific number. And if you're below that number, as in you don't have enough worth versus what you owe, they're saying that I'm not investing. And you're saying that does not seem fair. All right, let's drill down from the bank. Let's drill down from Macy's and let you and I have a conversation. You come to me and you say, I overhear you saying, oh, I don't have a job. I literally only have $10 in my pocket. And then you walk by to your friend and you say, oh my God, look at those, I don't know, look at those cupcakes. They cost $20. You'd be like, girl, can I borrow $10? You'd be like, you want to borrow $10? Yeah, but like, yeah, I'll give it back to you. She'd be like, how are you gonna give it back to me? You need $20 for the cupcake. You only have $10, so you're gonna borrow my $10. I overheard you say you don't have a job, you don't have any money in the bank. How are you gonna give me back my $10? Based on the information that I know about you, the probability of you giving me back that $10 is highly unlikely, because I know your financial situation right now. And unless you can tell me, no, I've got some money coming in that I am not privy to, you're not getting my $10. No. Does that make sense? Yes. So if a friend is borrowing money from you and you know they don't have any income coming in, and you know for a fact that they already owe Tom, Dick, and Harry money, why are you going to take up your money and lend it to them? No different from the bank. So that's why the bank wants your your historical performances in regards to your financial situation. As a friend, if you're going to borrow money from me, I'm going to know when I'm going to get it back, how you going to give it back to me, do you have a job to get it from it, and do you have any equity? As in, if you don't give me back my money, I'm going to hold on to no different from the bank. Does that make sense? Does it make sense? So all of this in so when we get into certain ratios are going to be like, oh, snoozeville, this doesn't make any sense to me because I'm an individual and I'm not a corporation. But some of them are very relatable, and I'm going to try and get those relatable ones in regards to how important it is. And what will be the takeaway? I've said this all the time. Your reputation is the cornerstone of your power. Guard it with your life. I've said that all the time to everyone that I've met. Write that down. Your reputation is the cornerstone of your power in anything and everything that you do. Your financial reputation is the cornerstone of your financial power. Guard it with your life. Your financial reputation will be the cornerstone to your financial power. So guard it with your life. And that's when it comes on to ratios, I want you to get in the takeaway. Does that make sense? All right, so let's get into some of them. So as we've mentioned with the balance sheet, right? So the balance sheet, what is the balance sheet? One of the four main financial statements, right? And it gives you a snapshot of the overall health of the organization. The balance sheet also gives you the accounting equation, right? Which is on your midterm. Assets is equal to what? Liability plus owner's equity. With the balance sheet, there's a lot of information you can get by getting a company's balance sheet matched up with their income statement. You can be like, you can get so much information from it. You throw in the cash flow statement, if that company has a cash flow statement, and you literally can unlock the overall performance of it. Now, there are some drawbacks in regards to using ratios, and a few. The main drawback is that usually with ratios is that you're obviously looking at past analysis, right? So if I'm getting a snapshot of your overall health, it's in the past. It's not necessarily current, because by the time I get it and look at it, life is fluid. And if I'm looking at your income statement, it's already in the past, or your cash flow is what have happened. So one of the limitations in regards to ratios is that you're looking at past analysis, and when you're using analysis based on past data, things can be happening in the future that ratio doesn't take into consideration. Does that make sense? For the most part, with all analysis and postmortem, it's always looking at what went on, and you can use it to be predictive, but it's not predictive enough, because it might miss some innovations, some economic conditions, some global competitions, some pandemics. There's certain things that are going on currently or in the future that when you're looking at ratios that are looking at the past, it's not telling you about the future. So that is one of the main limitations of ratios. Also, for the ratios to work, you usually have to compare it within the same industry. So if I am looking at, everybody knows Macy's. I was fortunate enough to work as a corporate individual, a corporate financial planner, neither here nor there for Macy's. But if any ratios that we're looking at, we would compare it to another large retailer that is of the similar makeup of Macy's. So you can't go outside of the industry when you're looking at that analysis. Most conglomerates and most large corporations operate in so many different industries. Everybody wants to diversify and to have different multiple sources of income outside of that specific industry, and usually their financial statements are consolidated. And what does that mean by consolidated? Meaning that everything is bubbling into one, and so it's hard to unpack so I can compare industry to industry. It wouldn't make sense for me to compare Macy's to a movie industry, because the numbers that what would be a ratio that is acceptable within the retail industry might not be acceptable in the entertainment industry, and vice versa. So I'll give you a perfect example. This is introductory to accounting. There's no way I would give you the same midterm or the same final examination that I would give to my intermediate accounting class. Why? Because I'm comparing apples and oranges. What you know is completely different from what someone that is a little bit more advanced know. So no different. With the ratios, you want to stay in the same industry when you're doing comparisons. And most conglomerates have multiple companies that are from different industries that are rolled into their consolidation. All right. So I've given you the drawbacks of it. We've discussed what are ratios, why they're important, why companies use them. Now let's get into the actual ratios. So the main ratio that most people use or know about is the current ratio. So that's the current ratio. And what is the current ratio? So the current ratio, it literally takes the company's current assets and they divide it by their current liability. That's the equation for current ratio. Current assets divide by current liability. And the reason why people use current ratio is literally to gauge the liquidity of the company, how quickly they can take what they own versus to pay off what they owe, but in a quick turnaround, because current is things that you can turn around, or you can turn around into cash within 90 days. In some industry it's a year. So that's why we're looking at current assets divide by current liabilities, and that gives you the ratio for current ratio. And you can look at it and say how quickly, how liquid the company is, meaning that if something pops off, how quickly can they pay their debt. All right, does that make sense? So the next ratio which we want to look at is the is your debt to equity ratio. And I've mentioned this ratio before, and this ratio is pretty important. This is the one that most companies, especially within the banking industry, looks at. It is your total liability divided by your total equity. And your debt to equity ratio basically looks at just your leverage. In regards to your leverage, is like how likely are you to default? I want to put it in as simple term as it. So it looks at the company's total liability to the company's total stockholders' equity. And that should tell you in regards to when you're looking at, when you're applying for a credit card, when you're applying for any form of loans, when you're applying for anything in regards to wanting somebody to borrow from a corporate position. People look at it that way. And even from an individual basis, people look at your debt to your equity in regards to just what is your leverage position, how likely are you to default. All right. And the higher that number is, meaning your debt, the closer it is to 1, it is telling me that you are more likely to default. And I want to give you a perfect example. If I have debt, which is what I owe, right, of $100, right? And my overall worth in life is, say, $150, right? So my debt, right? So if you're looking at my overall debt to equity, you're going to put in my total liabilities, right, which is 100, divided by my overall worth, which is 150. So I'm going to what? A 1 to a 1.5. So for every debt I have, I only have 1.5 to cover it. And it would be based on your judgment in comparison to somebody else to say, for every dollar that I owe, I have $1.15 worth. And you make the judgment call. Would you want to lend me more money? That's it in a nutshell. All right, does that make sense? I'm trying to make it as palpable and understandable as you possibly can. And you guys will definitely also do some independent research on it, but I want to get that. The next ratio that you want to look at is your working capital ratio. And the working capital ratio is a little bit different than your current ratio, where your current ratio is your current assets divided by your current liability. Your working capital is your current assets minus your current liability. So a lot of people get tripped up about it. So your working capital is your current assets minus your current liability, while your current ratio is your current assets divided by your current liability. Okay? Does that make sense? All right. So, like the debt to equity ratio, which is the total liability divided by the total amount of equity, the debt to total asset ratios is also an indicator of the overall financial leverage of the company. So this ratio, the debt to total asset ratio, it shows the percentages of a company that the company's assets that have been financed by debt or creditor, meaning that what if of your overall assets, what percentage of it is coming from you borrowing that money. And this is a great also indicator to say whether this company is over or under leveraged. And the ratio for debt to total asset is total liability divided by total assets. So the debt to equity ratio, which we look at total liability by the stockholders' equity, the debt to total asset looks at the total asset divided by total liability divided by total assets, and both of those are leveraging, look at basically how likely you are to default. So for your debt to equity, the higher the number is, it is a greater risk for your creditors and your prospective creditors. So if I have someone's balance sheet, and the first thing that I'm going to look at is their debt to equity, because it's going to tell me how high that number is, and that is going to tell me for a risk, as in me putting my money in. Now the debt to total asset, now your debt to total asset, what that will do, that will tell me what percentages of your overall worth have been financed by creditors or by debt. So how much people you owe. I know you're walking around with all of that, but do you own all of that? And if you don't, how much of it, what percentage of all of that has been borrowed money? Does that make sense? So all of that can be found using the financial statements. So just the level set, right? For prospective shareholders, because they're not on the inside and they want to make informed decision, the financial statements that are made for the public we can use those to find ratios to give you information in regards to the overall behavior and performance of the company. One of the drawbacks of the ratios is because it's always looking behind, it doesn't necessarily always take into consideration what is going on currently or future performance from a global economic scale. These ratios, even though some of them sounds like things that you might not really care about because you're not a corporation, these ratios also bubble down to a individual level that impacts you. Anything you're going to borrow money, if I am the lender, I want to know how likely am I going to get my money back. And one of the ways I can do it is to find out that your overall credit performance and your credit reputation and your financial reputation and your financial past. And I'll take your financial past and I'll compare it and be like, is it at the quota that I want to lend you money? So that in a nutshell is why people use ratios to make informed decision. So your online discussion this week will be tailored to ratios. There will be questions regarding ratios on the finals. So I would strongly recommend that you guys do what you always do and also do some independent research on it. Okay? Thank you guys very much. And I will see you on the other side of Blackboard.